Have you ever wondered how companies figure out the true value of their assets and liabilities? Well, IFRS 13 is the rulebook that tells them how. We're going to break it all down step by step. So, what exactly is fair value? IFRS 13 defines it as the price that would be received to sell an asset or pay to transfer a liability in an orderly transaction between market participants at the measurement date. That's a mouthful, right? Let's simplify it. Imagine you're selling a house. The fair value is on the price you hope to get, or the price a desperate buyer might pay. It's the price that you and a willing, knowledgeable buyer would agree on without any pressure in the current market. It's an exit price, not an entry price. It's about what you could get for it if you sold it today. This concept is market-based, not entity-specific. It doesn't matter how much you value your asset personally. What matters is what the market thinks it's worth. This is a crucial shift in perspective. The standard focuses on the viewpoint of external market participants, making the valuation objective and comparable across different companies. It's all about looking outward, not inward. Now, to determine this fair value, IFRS 13 introduces something called the fair value hierarchy. This is the core of the standard, and it's basically a three-level pyramid that categorizes the inputs used in valuation techniques. The higher the level, the more reliable and observable the inputs are. Think of it as a ranking system for the quality of your valuation data. Level 1 is the gold standard, Level 2 is the silver, and Level 3 is the bronze. Let S start at the top with Level 1. These are the most reliable inputs because they are unadjusted quoted prices in active markets for purely identical assets or liabilities. What does that mean? An active market is one where transactions happen frequently enough to provide pricing information on an ongoing basis, like the New York Stock Exchange. And identical means exactly that, the very same thing. So, if you own shares of a major public company like Apple or Google, you can find their exact price on the stock market at any given moment. You just look it up, and that's your fair value. No adjustments, no guesswork. It's the most direct and objective evidence of fair value you can get. Moving down to Level 2. This is for when you can't find an exact quoted price for your identical asset in an active market. Level 2 inputs are still directly or indirectly observable, but they're not that perfect Level 1 price. Quote, this category includes a few things. First, you could use quoted prices for similar assets in active markets. For example, you might be valuing a corporate bond that isn't traded very often. You could look at the price of a similar bond from a similar company with a similar credit rating that is traded actively. Second, you could use quoted prices for identical or similar assets in markets that are not active. Imagine a piece of real estate in a slow market. There might not be daily transactions, but you can still find prices from recent, comparable sales in the area. Other Level 2 inputs include things like interest rates, yield curves, and credit spreads that are observable in the market. You're essentially using observable market data to build your valuation, even if it's not a direct quote. It requires a bit more work than Level 1, but the data is still rooted in verifiable market information. Finally, we arrive at Level 3. This is the most subjective level of the hierarchy. Level 3 inputs are unobservable inputs. This is your last resort, used only when observable inputs from Level 1 or Level 2 are not available. Here, the company has to develop its own inputs using the best information available, which might include its own internal data. This often involves creating financial models, like a discounted cash flow or DCF analysis. For example, valuing a private startup company, a complex derivative, or a unique piece of intellectual property would likely fall into Level 3, because these inputs are not based on observable market data. They carry the highest degree of uncertainty and require significant judgment. The company is essentially saying, based on our models and assumptions, this is what we believe the asset is worth. Due to this subjectivity, IFRS 13 requires companies to provide extensive disclosures about their Level 3 valuations. They have to explain the valuation techniques they used, the key unobservable inputs, and how sensitive the valuation is to changes in those inputs. This transparency is key to helping investors understand the potential risks associated with these valuations. So, let's put it all together in a simple table to make it easy to compare. Imagine 3 columns: Level 1, Level 2, and Level 3. For the asterisk input type, Level 1 is quoted prices for identical items in active markets. Level 2 is observable inputs, other than Level 1 quoted prices. Level 3 is unobservable inputs. For the key characteristic Level 1 is most reliable and objective. Level 2 is observable but requires some adjustment or comparison. Level 3 is most subjective, requires significant judgment. For a classic example, Level 1 would be shares of a publicly traded company on a major stock exchange. Level 2 would be a corporate bond valued using interest rate curves or a building valued based on recent sales of similar properties in the area. Level 3 would be a private equity investment or a unique patent valued using a discounted cash flow model. And finally, for the disclosure requirement, Level 1 has minimal disclosure. Level 2 has moderate disclosure. Level 2 has moderate disclosure, including the valuation techniques, the inputs used, and sensitivity analysis. Seeing it laid out like this really helps clarify the differences, doesn't it? The hierarchy isn't about which assets are better or worse. It's purely about the transparency and reliability of the data used to value them. An asset's classification can also change over time. A security that was once actively traded might become illiquid, moving it from Level 1 to Level 2 or even Level 3. So, why does all of this matter? Fair value measurement provides more relevant and timely information to investors and other stakeholders. It gives a more current picture of a company's financial position than historical cost, which can become outdated. It allows for better comparison between companies and helps investors make more informed decisions about where to put their money. By understanding the IFRS 13 hierarchy, you can better analyze a company's financial statements, assess the reliability of its valuations, and spot potential risks, especially with those significant Level 3 assets. And that's our deep dive into IFRS 13 and the fair value hierarchy. We went from defining fair value as an exit price to breaking down the 3 levels of the hierarchy, from the most objective Level 1 to the most subjective, Level 3. I hope this breakdown and the comparison table make this standard much more approachable for you. Accounting standards can seem complex, but when you break them down into their core components, they start to make a lot of sense. Thank you so much for watching. If you found this video helpful, please give it a thumbs up. It really helps the channel out. I love hearing from you all. Till next time, keep learning.